What is the goal of tail risk hedging? Have you ever thought about how to protect your investments from unexpected market crashes? Tail risk hedging is a strategy designed just for that. The main goal of tail risk hedging is to safeguard an investment portfolio against rare but extreme market events that can lead to significant losses. These events are often called left tail events and are located at the far left end of the return distribution curve. While they happen infrequently, their impact can be substantial. In the world of stock trading and options, tail risk hedging typically involves using financial derivatives, particularly options. One common method is purchasing out-of-the-money put options. These options gain value when the market experiences a sharp decline. By holding these options, investors can offset losses in their stock holdings during market crashes or periods of high volatility. Think of it as an insurance policy for your investments, where the cost of the options is the premium paid for protection against these rare but severe market drops. Tail risk hedging aims to reduce the potential damage from extreme downturns while still allowing the portfolio to benefit from normal or positive market conditions. This strategy seeks to mitigate the impact of rare, severe market downturns that traditional models may overlook due to fat tails in real market return distributions. Investors often use options on indexes or exchange-traded funds, such as put options on the Standard & Poor's 500 index. These options can increase in value when markets fall dramatically. However, there is a balancing act involved. The cost of hedging can lead to negative returns during stable or rising markets, so investors must weigh the benefits of protection against the costs. Some investors also diversify into other assets, like United States Treasury bonds or cash, to provide liquidity and reduce overall portfolio risk. This approach is designed to minimize losses during tail events while preserving potential gains in normal market conditions. For example, specialized tail risk exchange-traded funds invest primarily in put options and safe bonds to provide downside protection. However, these funds may experience negative returns during prolonged market rallies because the hedge loses value when markets rise. In the context of stock trading and options, the goal of tail risk hedging is to reduce the risk of catastrophic portfolio losses caused by extreme market moves. This is achieved by strategically using options and other instruments as a form of protection, accepting some cost during normal times in exchange for insurance against rare but damaging events.